Hi, and welcome back to the Food Fund, where we explore all things related to investing in food and beverage stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in great companies. If you love food and love stocks, you will definitely for sure love this channel. In this video we will be doing an analysis of Oatly, everyone's favorite oat milk maker, and seeing if it would be a great addition to the Food Fund. Be sure to watch through the end of the video where I share my final thoughts on that. Before we get started, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, cue that amazing logo. Let's first start with a little background information on Oatly. Oatly was founded in Malmö, Sweden in 1994 and has quickly become one of the leading brands of plant-based milk, with its products now sold in over 20 countries. Oatly can be found in over 60,000 retail stores and 32,000 coffee shops worldwide. Oatly's success may be due in part to the growing popularity of plant-based diets as well as tapping into the more than 5 billion people around the world that have some degree of lactose malabsorption. This massive total addressable market, or TAM, represents a tremendous opportunity for Oatly and has captured my interest in the company. Starting with the 1-year chart, we see that Oatly had a CAGR of about -58.4%. Zooming out to the 5-year chart, we see that Oatly had a CAGR of -70% over the last 2 years. It has been very rough to be an Oatly shareholder. Now, let's take a look at the fundamentals. Gross margin is 13%. Could be better but could certainly be a whole lot worse. Revenue has compounded at around 49% CAGR and has topped $752 million on a trailing 12-month basis. Good revenue growth and a decent gross margin shows that Oatly's base business is pretty healthy. Looking at free cash flow, we see in -61% CAGR, while capex has increased at a CAGR of 43% and stock-based compensation increased at a 141% CAGR. While free cash flow was worsened overall, it has been improving over the last couple of years as capex spending slows. Stock-based compensation is growing very quickly but is so small that it is negligible compared with free cash flow. Next, weighted average shares outstanding have been increasing though at a negligible rate. Unfortunately, Oatly has recently announced plans to raise $425 million via convertible debt instruments, meaning that more dilution may be on the way. Now let's view my favorite metric, return on invested capital. Return on invested capital has worsened from -12% in 2019 to -45% most recently. Given that Oatly isn't profitable, its return on invested capital will be negative. This is the exact opposite of what we want to see, and I eagerly await the day that their return on invested capital flips positive. Another favorite metric is cash conversion cycle, a measure of operational efficiency at the company, going from 84 days in 2019 to 45 days most recently. Oatly is demonstrating improving leverage. Oatly is slowing improving the quality of their business, but it may take several quarters before this improvement is seen in free cash flow. Last, let's explore Oatly's debt metrics. We will be looking at the current ratio, the debt to equity ratio, and the net debt to EBITDA ratio as we defined those terms in a recent video. For Oatly, the current ratio is 1.1. The debt to equity ratio is 0.4, and the net debt to EBITDA ratio is -0.4. The fundamentals of Oatly are not good, but they seem to be improving. Is it too early to add it to the portfolio? Before sharing my final thoughts on that, please subscribe, like, and share this video. Your support means a lot to the Food Fund and your continued viewership is a huge help to grow the channel. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Oatly. It is a beverage company with a gross margin of 13%. Not a bad start. Since we only have 4 years of financial data, we will put that down for the 5-year metric data. Revenue per share CAGR is 49% and the free cash flow per share CAGR is -61%. The good news is that revenue is still growing at Oatly, unlike many of its plant-based peers. Spending is still an issue and is unlikely to improve in the next few quarters. A return on invested capital of -45% is bad, and we cannot really infer much from this metric until Oatly becomes profitable. Next, the cash conversion cycle of 45 days is not bad and is improving. This, along with revenue growth, are the only positive areas of Oatly. Concerning debt, a net debt to EBITDA of -0.4 means that Oatly is still EBITDA negative. Frown face. So from a fundamental standpoint, Oatly is growing but is still wildly unprofitable. Now let's switch our attention over to valuation. Oatly's value relative to the S&P 500 is -0.1. Not much to say here except that Oatly is unprofitable. The price to earnings growth, or PEG ratio, of -0.1 reinforces that Oatly is indeed unprofitable. Last, let's look at some recent Oatly news to gain a better qualitative understanding of the company. Oatly named Jean-Christophe Flatin as the new CEO, replacing Tony Peterson, who will move to become co-chairman of the board. Flatin was previously the global president of the company and is said to be responsible for key improvements in the business model since joining the company from Mars Incorporated last year. On being promoted to CEO, Flatin remarked, "I am humbled and honored by the opportunity to lead this great organization. Oatly is a once-in-a-generation company with the teams, purpose, and products that are second to none. We have all the elements in place to strengthen our leadership position in multiple markets and fuel the societal shift to a more sustainable plant-based food system." To wrap it all up, Oatly is a growing company, flush with new cash, and a new CEO. Spending is decreasing, albeit too slowly for my liking. However, given all of its recent change, I am eager to see how this shakes out. For now, I will be willing to wait until the fundamentals improve, but will leave it on the watch list. Many thanks for watching. What do you think about Oatly and its spending? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.